Oh, hello, everybody. So first of all, we won't have webcam today. We had some tech issues here, I think actually related to the platform rather than hardware, but we're gonna figure that out. Not gonna figure it out today. And I think the focus needs to be much more on the content than my face on the webcam anyway. So apologies for that, but just kind of adjust to that. And welcome to the Hudson session number 6. So for those of you, it's your first time with us, I think it's going to be important to, as you have time, go back and see the previous sessions. All of this, the way I've described this, is that this teaching approach, and it's kind of built into the book too, there's deliberate repetition here because we need to see the same things from different angles and from different perspectives and with different layers of knowledge. So in other words, this is not really a field. If we're talking about discretionary pattern recognition, financial markets, this is not really a field that can be taught by learn this building block and then this building block and this building block in a sequential way. Many disciplines work in just that way. You can learn most of math like that. You can learn many arts like that. You can learn many skills like that. But this is a different kind of complexity. And the way I think about this is to imagine a visual of a bird circling around a green circle and then spiraling higher and higher and higher. And so it keeps going around the same place, but as it gets higher, you get a different perspective. And eventually you see that it's a tree. That's the way I think about learning and teaching this stuff. So you're going to see that very explicitly today. This is the part of the book where I am willing to bet that when most people buy a big book like the Art and Science of Technical Analysis and they open it up and they flip through, they probably go to chapter 6 because this has the chapter that talks about specific trading patterns. And this is what everybody wants, and this is where everybody thinks the important stuff is. But you're going to see today, as we look at these patterns, as we look at current examples of these patterns, and I talk about how my thinking has changed and evolved, we're going to see that this draws heavily from what I've done in the first 5 chapters and in the first 5 Hudson sessions. So all of that is a long introduction to say, if this is your first session, welcome. If you came here because you were interested in learning about the specific trading patterns, gotcha, right? I knew. And these will be much more powerful when you put them in context and when you understand what they're trying to show. And I think by the time we get to the end of today's presentation, you're going to see the need to kind of fill out that knowledge. A couple more things before we get started here. If you have questions, we intend for this to be interactive. I do have my team here, and I appreciate everybody, and I appreciate all of you taking time to come here on a Saturday afternoon, or, of course, wherever you are in the world, it might be a much less advantageous time on a Saturday. And, time and focus and attention is really the most precious thing we have. So for you to give your attention to me and to this topic, it's a pretty big thing, and I want to let you know I appreciate that. Appreciate my team's time, and they're going to help kind of curate the chat and the questions. If you have questions, type them in, and I'll try to get to them as we go along, and we'll make sure we get all of them at the end. With that, let's jump in here to chapter 6, and this is the quote that I put at the beginning. Do not blindly repeat the tactics which have gained you one victory, but let your methods be regulated by the infinite variety of circumstances. So this is somebody writing about war and antiquity, and of course you all know the book, The Art of War, but it applies in a very serious way to financial markets. This is one of the challenges of financial markets, is understanding, finding this balance between what changes and what does not change. That's kind of you could frame the question of how do I trade profitably and make that one of the central things you need to address. Because if everything changes all the time, then we could not trade profitably. It's worth thinking about that a little bit, right? So if you can imagine a world where everything changes in the market all the time, there would be no reliable patterns. There would be no hope of finding a trading edge. And there's some statistical tests for things that kind of hover around this, but what we do is a little bit different. On the other hand, it seems to me, if you didn't understand anything about markets and you were just thinking about the problem from first principles, if you understand, you have a lot of people who go into the market and they fight with each other to try to figure out how to make money, that people are going to find new tricks, right? And that there's going to be at least some evolution in the markets. And I've talked about this in previous Hudson sessions, this idea about the market being an ecosystem, and you can think of traders as kind of broadly falling into predator and prey groups. And they're really interesting ideas you can pull in from ecosystems where you look at evolution of camouflage, and then the predator develops more efficient ways of getting through that camouflage. And the same sort of thing happens in financial markets. So what this means is that there certainly is some evolution, and there's enough evolution that one of the quote truest, and I realize it's really a binary proposition, but let's say one of the most significant things you can say about financial markets is that change is maybe the only constant. The only reliable thing you can depend on is that different aspects of the market can change. Now, that's a great philosophical thing, but what we need to do if we're going to have any hope of trading profitably over an extended period of time, we're going to need to think a lot about what changes and what does not change. And I will tell you, the trading patterns that I have built this chapter around, and that in fact I built my trading around, really are based on principles and ideas that, at least as far as I can tell, have not changed. And so this gives me pretty good reason to expect that, to the end of my own life, we probably won't see these patterns stop working. However, what does change and where you will need to make some adaptations probably are in the specific application. So if you're trading, for instance, a pullback, you might see that the way market dynamics evolve around those pullbacks might cause you to have to adapt your approach in some ways. That's an important part of, once you find a trading edge, maintaining a trading edge. So this chapter, the title is kind of weird, right? Practical trading templates is what I call the chapter. Why didn't I just say my favorite trades, my favorite trading patterns, or best trading patterns, or something like that? Well, I wanted to make you think deeply. And this name was not an accident. So the idea, of course, is with practical, we've talked a lot, and for those of you who were with me for these other Hudson sessions, we got pretty theoretical sometimes. I mean, we're talking about nature, reality, and like whacked out crazy stuff like that. So some of that really doesn't have a lot to do with what you're going to do on Monday when the market opens. These patterns definitely address that. I think they're the pointy end of the spear is the way to think about it. These are the things that you can use. However, they're templates. So these are not patterns where you say, hey, Adam showed me this pattern, let me go find exactly this pattern. No, you're going to need to adapt. And if you're going to adapt, what this is going to call you to do is to understand what the pattern is doing, understand the ideas behind the patterns, and then to be able to internalize that, so you're able to then look at this flood of market data coming in, because everything I'm showing you, of course, is historical. That's obvious, but it's worth thinking. From the moment I'm speaking here, the moment you're hearing this, everything that happens forward is completely unknown to us. So what you're going to be doing is going through this process of matching this pattern template, this idealized pattern that you've internalized, with what you see coming in the market, and that's how you trade. And of course, to do this, the reality is that when you go to the market Monday, what you're going to see in the market and what you're going to do really says as much about yourself as the market. The way you see patterns, the way you perceive patterns, is as much about whatever underlying pattern is there and your sell. So the trades in this chapter, this is roughly how I laid out the chapter. It began with the failure test, and we also will, when we get into the actual patterns, we'll begin with the failure test today. And then pullbacks. I spent a bit of time in the book on specific entries for the pullbacks. Now, one thing that has kind of evolved in my language, at least, is if we're talking about trends, I have found two terms useful. One is the idea of in the trend direction. Now, we can say that, right? You can say a pullback resolving in the direction of the trend. It's a mouthful of words. This word trend word is kind of useful, and I don't really think I've heard anybody else talk about that. So trend word is when we talk about a trendward tendency, it's in the direction of either the existing trend or the trend we expect. Why do I qualify that so carefully? If you've been with me through these previous Hudson sessions, you know why I qualify that so carefully. If you don't, go back and watch the one where I dealt with trends. The opposite of trend word is leeward, so that is counter trend. And with the pullbacks, there are two possibilities. If you've identified a trend, you have an option of either entering here when the market hooks in the trend direction, or if you think it's going to be a good pullback, you have the option of entering here. And of course, what you're hoping for, what you're counting on, is in some kind of resolution like this, but you don't know. And these have different advantages and disadvantages with, in terms of probability and trail. Now, we're not going to talk a lot today about these specific entries. So this is a division that's in the chapter of the book that we're not going to focus on. We're going to have a Hudson session where I focus much more on actual examples, and we can talk about specific entries. And I'll also say, one of the things with the daily market work that I do for our Market Life family is we talk a lot about specific examples. So over time, the way you really learn this, I don't think you effectively will program. You got to go through like an apprenticeship. Let's say that, like if you're going to be a surgeon, you can learn everything, or you're going to be a pilot or whatever. You can learn everything you can from books and from simulators and from models and cadavers, whatever you're working. Hopefully more for surgeons than pilots, but that's and however, you don't really own the work or the abilities until you implement them, until you go through this period of doing the work in some limited capacity. So your exposures to the market are going to be very, very important to assimilate this. One of the major changes, I said that we would really focus on what has changed in my thinking. I've renamed the ante, which is a fantastic trade. We'll spend some time today talking about it. I've renamed it the snap pullback. We started doing that internally for our own trading for very good reasons. And then I realized that it made sense to kind of drip that out to the public. And it's hard to change names. We need to be careful about changing names with things. But I think this is an important enough change that I want to spend a little bit of time talking about that today. And then there are several variations of breakouts in the book. Now, what I'm going to do here today, as I said, we're going to eliminate the specific entries for the pullbacks, not talk that much about them. I'm going to put the snap pullback under the pullbacks, and the same thing with the breakouts. We don't really need to. We'll spend a little bit of time thinking about how you get in, how you get out. But the other kind of interesting thing, if you think about it, is that a failed breakout really belongs here. It's really a variation of a failure test. And this then becomes, if you're at all overwhelmed by chapter 6 of the book, and I think it's frankly, it's a pretty approachable chapter, but we're gonna recategorize things and think of it in a little bit more of a higher level division here, and you'll see why this makes sense. I also want to point out some things that have changed in my thinking since I wrote the book. None of these are super critical. I'll tell you, one of the big changes is that I sort of wish I had not started with the failure test, because I think a lot of people pick up the book and they see, okay, he put failure tests first, and this is obviously a really good trade, so I'm going to focus on the failure test. Well, I think if you want to focus on anything, that's a difficult one to focus on, because the problem with focusing on a failure test is that it's going to encourage you to always be fading the trend. And certainly there are times when you can fade a trend to very good effect, but this is not at all the basic default approach, and it's certainly not the basic approach that I think developing traders should take. You also don't see that many great examples of failure tests. So starting with a failure test, I think it's something I might do differently today. I might start with pullbacks, even though they're quite a bit more complex. But then there's also these other things, and this has been covered pretty extensively, this idea of a reversal complex. And for those of you who are just with us for the first time today, what I meant by this is not groundbreaking. None of this is, like nobody's ever going to show you a real technical trading concept. Once you kind of know the territory, nobody's going to show you something that is totally revolutionary. Everything, and so then the danger with that is once you learn a little bit, it's easy to get jaded, isn't it? It's easy to say, oh, I've seen this shit before, it's just the same stuff, I'm not really going to pay attention. But this is a subtle thing that I think does make a big difference. So everybody knows about a traditional reversal bar. So it looks something like this, and the candlestick people talk about pin bars because just the way I'm drawing a bar here, but if this were a candlestick, you can imagine it would look something like that. And so you're focusing on this big tail, which shows some kind of price rejection, which gives some potential for a reversal. Everything I just said is true. There's also another possibility, though, which is that you get something like this. So you have this same thing accomplished in 2 bars, or maybe 3 bars, or maybe more bars. So it's this idea of, rather than looking for just one, very naive pin bar approach. And I do think that all of these simplifications, we've talked about these, people who try to simplify price action too much, you can miss enough detail that it becomes a problem. But being sensitive to the fact that it doesn't have to happen in a single bar or a single session, particularly intraday, because those time divisions are arbitrary. But I would, you might even call into question the daily bar a little bit. So many of the things that we would have done, that we would have done in very simple single bars in the book, we now can see play out in multiple bars, these reversal complexes. I place much emphasis on nested pullbacks. We'll talk about that, but it's just when you have a pullback that starts to work, and then you have some kind of little pause, which can actually just be a bar or two. It's not actually like a nested pullback, it's a nested pause inside the resolution of a bigger picture pullback. Those can be really, really nice trades. Talk a little bit about the structural trend change today, which is nothing more than some variation of a double bottom or a double top. That would actually come after something like that. And then we'll talk a little bit here at the end about the simple change you can make to skip a specific kind of trade, a specific pattern that's going to save you a little bit of pain, probably do good things for your win ratio. I'll talk a little bit about perception here. So as I said, when you look at these patterns, when you go out to the market, when you find these patterns, what you see really says as much about that which does the scene, as I said here, about your brain and your eye and yourself, as it does about what pattern is in the market. Now, I don't think we need to spend a lot of time. I think everybody, there have been a lot of, and I found these funny pictures, you can see these. A lot of people over the past decade have written extensively about cognitive biases and about the human tendency to find patterns where none exist. And I think that's useful to know this, but I think also we've seen that even though it's very easy to go to the internet and find trade blogs written for traders that list 40 or 50 different cognitive biases, that doesn't really do much to help traders, because just being aware of these things does not insulate you from the, being aware that you might make the mistake does not prevent you from making the mistake, because it's just such a wired in part of the way we process. So from a practical perspective, what I think is very important is to train ourselves in a way that we're always mindful of the possibility that, hey, I might be making this up. And specifically looking at a pattern in the market, maybe this is a real pattern, maybe I'm making this up. There's no way to know for sure. So the first thing if that's your basic framework, the first thing is that there is no trade then that justifies you taking a gigantic risk, right? If you're constantly mindful of the possibility that you might very well, this one particular time, I don't care if you have 5,000 winning trades behind you, there's still a chance when you see this current pattern that this is some quirk of your human perception. Maybe there's not actually a pattern there. So if you're aware of that, then you're never going to go in and do something silly like risk half of your trading account on one single trade. And when the trade doesn't work, even if you get, and this will also avoid a lot of the common mistakes, like where you get into a trade and the trade doesn't work and you get angry and you put more, you pile into the trade more. A lot of these kind of stupid beginner mistakes, which we've all made, I've certainly made them. If we're just humble about our perception, then we're not going to make some of those mistakes. And this is also as we are spending time training ourselves to see patterns, we need to be aware that we're not just looking at patterns in the market and learning to recognize patterns, but we're training our perception. As this quote here from Jung says, we're teaching ourselves the art of seeing. And this to me is, I want to spend a few moments here talking about psychology, even though there is a chapter in the book on psychology, because I think the way psychology is interwoven through all of this process of perception and trading is very, very important. And many of you know that I've been working for a couple of years here on a book on trading psychology, and I want to share something today a little bit that I'm very, very excited with. I saw a real need for this, as I could spend hours just ripping on trading psychologists. I won't do this, but I'm going to share something here. Look at this slide. So I can't resist myself. So here is one of the biggest names, who was one of the biggest names in trading psychology, in response to the question, can you give me an example of a trading edge? Now, for those of you, again, who have been through these Hudson sessions, you understand how we define a trading edge. This is something that when we see a condition in the market, and it could be any number of things. It could be a pattern, it could be some fundamental situation, it could be we have some information advantage. There are many possible ways to find an edge, but we have these conditions that must be quite precisely defined that give us some reason to make a trade. And here's a psychologist's response to, can you give me an example of a trading edge? Understanding that you don't have to trade every day. Understanding position sizing strategies and how to use them to meet your objectives. Being aware of your thoughts and feelings. Knowing your reward to risk in a trade. Well, frankly, every single one of those is utter nonsense, and you know that. None of these things would give you an edge in the market. Now, they might prevent you from blowing yourself up, which is fantastic, but it's not. This is the issue with much of trading psychology. It tends to play down the absolute necessity. I mean, let's just say this, of having a reason to put a trade on. That's really what it comes down to, right? You have, imagine this, you have your trading account, market's out there moving, you have on no position, so you have on no risk and no potential to make any money, right? Because you're flat, you don't have a position. So then something happens in the market and you put a position on. Now you have the potential to make money, but you also have the potential to lose money. So what justified you putting on that, taking that risk? It can be nothing other than a trading edge. Now you tell me, do any of these qualify? If you're aware of your thoughts and feelings, you have a reason to push the button. If you understand you don't have to trade every day or every minute, I mean, great, don't overtrade. It's fantastic advice, but it's not an edge. So how do we do this right? how do we avoid that kind of woo-woo nonsense? I've spent over the years a lot of time working with and training traders, everything from traders who have yet to place their first trade to I've worked with many traders who traded for decades on the floor and then tried to transition to the screen. And it's been a real education for me because it's interesting to see what translates and what doesn't. Because, for instance, I've seen more than one person who made millions of dollars every year trading on the floor, holding gigantic positions. I've seen people who are very, very comfortable having gigantic positions on the floor be unable to deal with the emotions of managing a small position on the screen. And all of these weird and bizarre things hit people from all of these different directions. And frankly, I'll tell you, I know I can be kind of a contrarian, and I know I can be very cynical sometimes, but where this comes from in most cases is that many of the traders that I had worked with had kind of exhausted all of the possibilities. It seems like many people gone to every place they could before they came to me. People worked with very, very big name trading psychologists, like if you watch the show Billions, which I think is better this season, right? Wendy Rhodes is modeled after real people who do that on Wall Street. And some of these people work with individual traders, some of them don't. And time and time again, these people had worked with psychologists and not gotten anything out of it. I also, however, at the same time, here's something radically different. I haven't really shared this in my trading world very much, but I have done pretty extensive work with hypnosis and working with people in kind of a hypnotherapy context. And time again, I saw people resolve really crazy life situations, things that you would think could not be affected. Just basically somebody sitting down and interacting with them in this very special way. And I also use these tools in my coaching and training of traders to help people break bad habits and avoid some of the silly things. So I was seeing like all of this positive stuff happen with the work that I was doing with, there's ostensibly trading psychology, but then I was seeing things not working when people would try to apply what is out there. And I realized that the real problem is that you really have to have this balance between psychology and methodology. Why? Well, we're talking about patterns today, and this is a reinforcement of the fact that when you look at patterns, knowing the pattern is really only part of it, because pattern recognition is partially the pattern in the market and you, right? We've established that. But then all of these other things are important. And I'm giving this as a caution, because what I don't want you to do is what I did early in my trading career, where I would read a book, or this is really kind of before there were a lot of websites, but there were bulletin boards and various ways of exchanging information electronically. And so I would see this pattern somewhere, basically on the early internet, and then I would rush and trade that pattern. I would just, and it never worked out. And in fact, it worked out so badly that it's kind of comical, because I was then, after I developed as a trader and figured stuff out, I was able to go back and use many of those patterns that were repeated catastrophic failures for me early on when I was a different trader. You never stand in the same stream twice, right? When I was a different trader, a different person, I was able to apply these things. So this is just a caution. Again, thinking about Monday morning when that market opens, I'm going to teach you a lot of things that do have practical application in the market, but don't just rush to push the button on these things in the market until you have integrated them. You're never going to succeed until you have a full trading approach that speaks to everything about you, to your personality, to the realities and limits and strengths of your life situation, strengths and weaknesses of everything around you. This is one reason why people say, it's a glib saying, but it's absolutely true, you're not going to make money with somebody else's system. You have to adapt it for yourself. And we need to think a little bit more about how to do that. I've also seen in this work with traders, many traders have successful systems and be unable to execute them. I worked with a guy, again, somebody who had traded on the floor for a while, who had a lot of wrong ideas about indicators, and got those ideas oriented in the right direction, did pretty extensive manual back tests, found a system that worked, knew exactly what he should do each day. He was an intraday trader. And so, he would identify levels and trades that he should trade around, and then he would just simply not do them. And I worked with him for quite a while, and this was just a repeated pattern. Last I knew, he decided that trading wasn't for him anymore. But it was a bizarre thing, because we were both perfectly aware of it, that he knew exactly what he should do, yet he was unable to do it. So at the same time, I spent a little bit of time here ripping on trading psychologists. It's a really important field. And here's how I think, and tell you a little bit. I've been very, very involved, and some of you probably noticed I've been a little bit less present in some public forums and social media. It's because we've been piloting a program that I'm calling Tradecraft, that I don't know. I don't want to give you a big ad here, but I do want to encourage you to take a look at it, because this is I'm very confident saying this is the best work I've done in over a decade training traders. And we have a group of about 100 people who've been going through it. The feedback has just blown me away. People's experiences, everything I had hoped and more. And I'm going to tell you about Tradecraft, but if you want to kind of go out on the venture yourself, here's what I think you need to do to be a successful trader. So we're talking about this line number 3 here today, I hope. When we get into these patterns, we're going to be looking at patterns that are actually there in the market. But I think before you're ready to push the button, you got to do these other things. You need to spend a little bit of time understanding how we see and making our filters, and what I mean are our filters to perception, as clear as possible, making our models as accurate as they can be. And again, this is what I've tried to do in the previous 5 Hudson sessions. This is why I talked about the, kind of there was a moment there where I realized I was really, really far out on a limb, where I was talking about the possibility that nothing we perceive is actually real. To challenge you to think deeply about these things and around these things. And if you go back, if you haven't seen those, please go back and spend some time with those. And then this is about having a good trading plan, right? Understanding, okay, what's the right thing to do? And then how do you get out of your own way? And how do you execute and kind of act as your self-coach? And this is the process that we built into Tradecraft. I'm not going to spend much more time here today, but I will just tell you that what we have been able to do, there's nothing like this out there. It's a combination of these 4 key content areas that we're calling pillars, which is one of these is a set of very focused questions dealing with your life, your personality, your inclinations, the realistic limitations you have, and figuring out how you can best trade. And this work has grown out of my own work as a trader, and of course, this training and coaching hundreds of traders over the years. Skill sequences are really cool. These are experiential sessions where we've talked a lot in the Hudson sessions about randomness. And what we do with the skill sequences is we begin with a deck of cards, and you identifying and looking for runs in random data, then executing random trades in a simulated environment, and slowly adding various elements of control. So what this does, this helps you avoid things like thinking risk reward is the most important thing, because you see the interplay of randomness. You see how all of this plays out in a very noisy market. Also, very, very focused sessions, which encourage you to do your own work, going through, taking like what we're doing today, looking at patterns, and then you kind of build, you basically writing your own trading book based on your work, getting down into the details of the market and really understanding the patterns. And then there's also some really cool trance and hypnosis stuff that, and meditation stuff that is actually able to tweak some of the behavioral issues that traders deal with. I'd like you to come and check it out. I'm going to talk a lot more about this Monday. We'll spend a lot of time here, so you can sign up for these links. And maybe, team, if you can drop one of those links in the chat, just so people can click on it, because they can't click here. Really excited about this, and I don't want to take much of your time today with it, but I can talk for hours about it. So with that, let's jump into the specific patterns. And I'm doing a combination here of graphics from the books. So this is the failure test picture here from the book, but also pay attention because I'm bringing in a lot of new examples here. So the failure test, the idea here is this is Wyckoff's spring or up thrust. So the market has defined a level and trades beyond that level and then reverses. This is the failure test bar, which shows that there was really no interest in buying the market up here. One way to think about this is a lot of these failure tests are basically stop runs, meaning that the market is kind of chopping around and people, you can imagine there are groups manipulating the market. And, again, this is why you have to have all this context, because we talked this, I'm bringing in the composite operator from Wyckoff, says, hey, I wonder if we can get a little bit higher price if maybe the public is looking to buy this breakout and they sell it to you and it fails. So it's a variation of a failed breakout with a very specific pattern, and your entry for these patterns can either be on the close of the failure bar, or another way, and a nice way for traders on the daily chart to trade, is to look to enter the next day if the low of that reversal bar, and of course, you can flip it for long, that goes without saying, but what you would be looking to do here is to enter with momentum, with kind of follow through momentum from that. Why is this a good pattern? Why did I start with this pattern? Well, it's easy to identify and it's easy to enter. If you're a trader who only can be at the screen for a few minutes each trading day, you can trade daily bars and trade a failure test, because you just need to know. You can either look as the bar comes close to closing, and obviously, it's a daily bar, but you could do it on hourly or whatever, just check in every hour. And if you have a failure test, you can then execute, or you could enter on a stop under the failure test. They're easy to enter. They have an objective stop point, meaning that when I say objective, it's not up for debate. Your stop needs to go probably beyond that high, or many times I will go a little bit inside that high, just because I don't want to be slipped. The reality is, if you start to trade back up into this area on this trade, you're probably in trouble anyway, but you certainly can define where you're going to put your stop and be very consistent with that. This is a trade that it's easy to be consistent with. Cons, negatives here. Well, so expectations can be limited. If we look at an example like this in a book, what we would show is, and then the trend reverses and the market collapses and you can just stay short for 8 months. It happens, but it doesn't happen that much. What happens much more often is that something like this is all you get. So you're definitely going to need to think about how you take your profits. And one thing to think about is, this is a good case. You make a good argument. That's not quite right there, but you make a good argument for looking at a 1R profit. So you can get short here, and you can put your limit to cover on once it hits your 1R target. Another problem here, and this is probably the big thing. This is probably the thing that has generated the most angst for me with putting it at the beginning of the book. I see a lot of traders, I see a lot of discussions where people are going through this chapter, and it's making them always look for reasons to fade. And so, I get tons of emails, people saying, is this a failure test? Is this a failure test? And what they're not doing with this is they're not really putting it in context. And we'll talk about that as we slide into the end of this presentation today. Failure test refinements. So ideally, you kind of want it to be a biggish bar. Maybe a good way to quantify it would be you'd want your failure test bar to be at least an average true range, maybe bigger, probably bigger. You do want a strong downward close. These are concepts we've talked about in earlier Hudson sessions. Ideally, you won't see it every time, but you might like for it to reverse several closes. Absolutely would consider reversal complexes. They're as valid as single bars, but two things about this. So I'll show you, actually, let's just jump to the next slide. I'll come back here. So reversal complex, this is not a reversal complex. These two bars, these, and I didn't circle them perfectly, but if you look at this and you say, okay, well, Adam said that reversals can happen over more than one bar, and this reversal happened over more than one bar, and this close, closed under a bunch of previous closes. So I'm going to call that a reversal complex. It's not. What this is follow through momentum. This is a reversal complex. This is a reversal complex. These three bars arguably could be a reversal complex. These three bars might be a reversal complex, and these. So I picked the ones there, obviously, off a very visible way, places that work, but that might be a reversal complex there that did not work so well. The danger you're going to get into, and there are other things you could call reversal complexes here, but the danger you're going to get into if you start to call this a reversal complex is you're going to end up entering on an extension. So you don't want to, look, if you just look at the average swing length here, your swing here to this point is most of an average swing length. So just to be clear, that's one of the dangers of talking about reversal complexes. And in general, the reversal complex, I said one of the nice things about this pattern is it's so clean and simple, but if you have to be aware of reversal complexes, and you do, I'm sorry, I think you do, then this does introduce some complexity, and maybe we can start to have some arguments about what is a failure test and what is not. Stop location, I showed you this. Typically, we would put just beyond the new extreme. I do like inside, and sometimes people get very angry about this. It's funny what people get angry about, but if I would suggest, so let's say you would short this bar. Okay, so you're looking to short that bar. Where do you put your stop? The obvious place to put your stop is here. And some people would argue to put a stop here to give it a little bit of room. I think it's very stupid, because this kind of action is typical. Look what happened here. Once they were able to take out this high, it's really hard to say how much farther is it going to go, because so if you want to add a little bit more room there, all you're doing is increasing the distance to your stop, decreasing your position size, or increasing your loss without any clear trade-off in probability. So I don't think that makes sense. This, however, can make a lot of sense, something like that. And this is where people get angry, because people say, no, don't you know you have to put the stop where the trade is not valid. Now, I know that's kind of the concept, but no, I don't know that you have to do that. And I do know that if a failure test fails, meaning that if it were to trade back up to that level, I'm in so much trouble in the trade, I don't want the damn thing anymore. The other thing that you might think about, which adds some complexity, is thinking about a time stop, because if these work, we should see pretty clear downside momentum. And if you're in a failure test and like 4 or 5 bars later, it really hasn't gone anywhere, from a practical standpoint, if you had shorted this bar, let's say your entry is here and your stop is there, that came really, it probably got your 1 hour target there. If your stop had been up here, it would not have. But point being, if you'd shorted in this area and then you're back up in here like 4 or 5 bars later, you don't want that trade. That's not really what you're looking for. What you're looking for is, if you're looking for one of two things with a failure test, you're either looking for a very extended quick move, or you're either looking for a very extended move or a quick move. So if you're looking for the quick move, you got it here and you're out. If you're looking for the more extended move, then seeing buyers step in means you're probably not going to do it. And the way you're probably not going to be able to make that happen. And the way you evaluate this action is precisely the same way you evaluate pullbacks. Again, all this is tied together. You really can't tease it apart for good reason. Here's another example of a failure test. So this is a failure test with a reversal complex here. Just to be clear, the reversal complex is these 3 bars. It worked. You would have gotten away with it if you had called this a reversal complex, but it's not. It's one extension. And this outcome where you have that and then another bigger extension, and that, that's pretty uncommon. You're not going to see that a lot. This also highlights, so you had a successful opportunity to buy somewhere in here, and notice your expectation was kind of limited. You ended up like, you might, and there's going to be some subset of trades where you buy here and then you break through that level and trend higher. But if you're sensitive to price action, look what's happening here, this failure, and certainly this bar. I mean, I don't want to put absolutes on because I know people trade lots of different ways, but to my thinking, if I had bought here, somewhere in here, if I want to hold it for a big move, I can't be long after that, like that kind of failure. So you definitely need to, if you're playing for those bigger moves, you need to be sensitive to developing momentum and price action. And that's what I meant when I said earlier about the different momentum variations. Here's just highlighting this failure test here. I don't think that one was quite as actionable, but do notice that broke through the low. I think it's interesting, and if you want to study these patterns, this is an area to consider. What happens just after I stopped drawing that line in this area, because this is not really a failure test. If you look here, you'll see there's a difference in the dynamics from there and what we identified before. So what we're really talking about here, and just a quick revisit, is the failure test is price rejection or price acceptance boiled down into one simple pattern. And Wyckoff called these springs and upthrusts. And I don't find those names, like, anybody who talks about Wyckoff, we have to understand what those names mean. They aren't super intuitive to me. And I think the issue is, my issue is that, so, we're talking about action inside of a theoretical range. And let me try here, see if I can draw straighter lines than that. Okay, so a spring is where the market trades down below and closes back up above, and then we kind of expect some kind of upside follow through. This is a spring. An upthrust sounds too much like a spring to me. It's where the market fails to go high and then sells off. So if you struggle with these, and I see people who have read Wyckoff for a while, and they're somewhat confused by the idea of springs and upthrust, it generally goes back to this. I think the spring is intuitive because you boing, right? You bounce up from the spring, but it's not so clear. The upthrust sounds to me, if you just give me that name, it sounds to me like a trade that I would expect to go up, but the upthrust is a failed upthrust. That's a trade that goes down. You may have been okay with that, but you may have already known that. But if you didn't, it's something that really can trip people up for a long time. You do need to be aware not to get too silly, but if the failure test fails, so we're talking about a failure of a failure test, then what you have is price acceptance. And when this happens, this more likely than not leads to trend continuation. Now, if you trade failure tests, you care about this a lot. Here's a recent example from Berkshire. And this is something that we were talking about on a bar by bar basis every day in one of the educational components of our daily market life work, where this is actually a really good example, because we went up here and we had a failure test, and at this point, you were probably justified being short. We had been long for a while, and this got us unlong. Okay, so when you see that's enough action against the long position that I think it's difficult to hold a long. However, if you had shorted, which was not what we were looking to do, but if you'd shorted, you wanted to be really sensitive to this action. And this also, there's lots of ways you can use this information. If you had gotten out of your long, you could have looked at reestablishing on as the trend resumes. So this is a good example of a failure test that fails. What does it fail to do? It fails to generate counter trend momentum. And this is actually a really good example of a failure test. I think like we probably talked for an hour about any of these examples, right? But this is a good example of a failure test because you have a market that's in somewhat of an extended trend, and then you had something that looks a little bit climactic. Again, all of these concepts swirl around each other, and we've talked about climax in some previous Hudson sessions. However, given the length of this pullback and a few other factors that I think are kind of special to individual stocks, we were justified in taking a long position. And also, given this context, and the context here was this previous climax, this, I reacted a little bit more strongly to that failure test than I might have reacted to a failure test in another context. A lot of layers, a lot of things to think about, but I hope this makes sense. If that doesn't make sense, if you want me to revisit that, ask a question. I'm coming up on a brief pause here, but let's wrap up failure tests here. So most examples aren't textbook perfect. It's very important, I think, if you trade with the trend, to be aware that these failure tests can be pretty strong evidence against your trend. And remember, if you trade failure tests, that just because you see one, not every failure test leads to a major collapse. This is a valid failure test, and it's a failure of an outcome. And you just have to remember that even the good ones many times just lead to a relatively short move. So I want to take a little bit of a pause here for my voice, pause about 5 minutes, and we'll come back and continue with failed breakouts and the rest of the patterns. If you have questions, good time to type them in the chat box. I'll see you in 5 minutes. Okay, welcome back. Let's go. A few questions here. How do you know if the market has shifted and your trading strategy requires adjustment versus just a sequence of normal losses and the system is still valid? That comes from Mark. So, Mark, it's a good question. It's kind of the question. You don't know, and you know, I'll tell you that because everything here works within the bounds of statistics. And what you can do, the book, if you have the book, and I hope you do, let me just flip through here. There is actually, hang on just a second. Okay, rather than me flipping through the book, there's some stuff on evaluating trades, evaluating system, evaluating stability in the back of the book. And I think Betsy's going to drop the page number in the chat here at some point, but she had no idea I was going to do it. I just threw the book at her and said, hey, find it. What you basically, the concept is, and this is drawn from manufacturing tolerances on assembly lines, where, and obviously, you know, if you're doing metal work, the tolerances are very, very small. And what you're able to do in an assembly line is you look at all the parts that come off and you look at the variability. So you're looking at, you know, the deviation between part to part or random samples, and you do this with your own trades. There are different ways, and that's why all this stuff is in the back of the book. And we'll cover this in a previous Hudson session, but I don't know, you know, when we'll get to it. You graph your trades, you look at the variability of your trades, and what you're looking for is some evidence that it's gone outside of normal statistical bounds. Now, it's quite easy. So page 394 and following in the book. As I said, it's quite easy to do in metal work, and you know very quickly if you have a problem on an assembly line. It's a hell of a lot more difficult to do in trading because the ratio of let's say the ratio of signal to noise is much lower, or the variance is much, much higher. So it's hard to identify with precision the exact point. But one thing that one easy way to is be aware of strings of losses. Now, these will sometimes, and this is a theme in tradecraft, these will sometimes just happen as a result of random luck. You just got a shitty draw, and even though you trade a system that wins 70% of the time, you just had 4 losing trades in a row, and perhaps nothing is wrong with you or with the system or with the market, and you know, you need to understand all of those things. But in that situation, those 4 losing trades in a row would be, to me, a flag to kind of pay attention. And a lot of different ways to do this, but it comes down to the precise way that I show in the book, and you may wish to do this in a little bit more of an intuitive way. You can also graph your P&L. It's not reliable because your P&L is going to be noisy and you're going to be in a drawdown almost all the time. That's the great reality of trading that that doesn't sound so good in marketing. Here, open a trading account, and if you're a really good trader, you're going to spend most of your life in a drawdown under an equity peak. That's absolutely the reality of trading. But so you can't respond to every drawdown or you freak out. And you also will, of course, have some drawdowns that are longer, bigger, deeper than others, and it can be a little bit hard to understand that. It's a good question. It's a very important question. There are answers, but those answers don't, let's say those answers don't veer to the point of certainty because everything is kind of within statistical balance. Norbert asked, what's the best higher time frame tendency for the setup? Okay, I'm glad I read that twice because I misunderstood it the first time. So context, and we'll talk a little bit more about context. But Norbert, in your question, you say overextended, climax, free bars, momentum divergence, and I would say yes to all of those. So what you're looking for here is if you really want to use the failure test or a failed breakout, that's where we're going next. Spoiler alert, if you want to use these effectively, you probably have the best luck with these if you have some reason to look for a trend reversal. Again, it's a concept I've already talked about in previous Hudson sessions, but if you imagine two traders trading failure test, and one just read like the 12 pages in the book that talked about failure tests, and he's going to go find every example of a failure test. And then you have another trader who understands that about the pattern, but he's not going to start looking for them until he has some evidence that he has some reason to think the trend might fail. So that's the second trader is going to use context to tell him we should really be paying attention. And you've listed a lot of the important points there in your question. So yes, the short answer to your question is yes, you got it. Frank asked, have I tried to algorithmically define failure test entries? Yes, I have. We have various filters for those. There are ways to trade them systematically intraday. I don't find any of the systematic approaches are quite as good as trading them from a discretionary standpoint. I trade them manually, and I'll say it here first. One of the things that you're going to be seeing from my work here over the next few years is we're going to be doing increasingly more systematic stuff. So if you come back, I don't expect I'll be trading failure tests, but if you come back and ask that question in a few months, I'll probably have more specific answers. Ray says, I find that, and I'm reading this question aloud here, so read it, depending on where the reversal complex or failure test bar closes back below the level watched, looking for a pullback in a lower time frame, or even placing a line where a level helps to trade a location and not entering on an extension. That's a good point. Yeah, very good. I think that's the right way to think about it, right? Okay, let's go on. Failed breakouts. And I know it's backwards. We're talking about a failed breakout before we talk about the ones that work, but failure tests many times are failed breakouts. There's a lot of overlap. Also, failed breakouts are very common. It is, however, highly dependent on definitions. So what are you expecting with a breakout? And it's worth spending a couple moments here thinking about expectations. So let's say you have a market that's kind of doing its market thing here and chopping around, and you're going to look at a breakout above that level. Now, what do you expect? Do you expect a market to go like that? If that is, let's say this, that's a possible outcome, right? And that's the outcome that you're going to put on a social media post and whatever. It's the one you're going to be talking about for years. It happens. But if this is your definition of breakout success, then let me say you're going to call a lot of things failed breakouts that would have been profitable trades, because other possibilities are you have your breakout and you have a little something like this, and there was really plenty of room here to have a profitable trade. And just because when you glance at the chart, you don't see this gigantic extension, this does not mean the breakout failed. So you're going to need to be, I think, quite specific with how you define failed breakouts, because definition matters. Also, what do you expect from a failed breakout that works? What, Adam? Okay, you're like, I know. So hang on, we'll get this. Okay, so here you have your market setting up a breakout. Okay, so now let's assume we're going to look for a failed breakout. So what we're looking for here is something that does this, right? We tried to break out above this level and we were not successful. So this is a failed breakout. Now, if we're trading this failed breakout, and if you got it, I'm sorry to belabor the point and be so clear here, but it is potentially confusing. So I want to be clear. So if you're trading this failed breakout, you are short this pattern. You're short somewhere, on the right-hand side of this chart. And what works? So what if you have, then the market does this? Now I would ask you, is that a failed breakout? So you got short here, and then a couple months later, the markets, or 2 days later, depending on time frame, of course, 5 minutes, I don't know. The market's a lot higher. Did this fail? Well, maybe it hit your profit target, right? And I do find when you're looking at these kinds of patterns, this is a good case to think about a 1R target. And if you just wanted to go through and roughly categorize, it's not a big move. If you want to categorize breakouts, failed breakouts that work versus those that don't, you can use a 1R target. So look here. There are there 1 or 2 failed breakouts. Here's the question on the chart. But let's say you take the second one, and let's say you had a really what I consider to be a disadvantageous entry. So you entered short here, your stop is here, just eyeballing that target that's here, right? So this is some short entry somewhere in this broad area ends up working based on your 1R target. Now, question is here. Here's another failed breakout. And is this a working trade or not? Well, if you entered this close, I think you're a little crazy if you did. That's not a trade I would propose, but that probably hit your 1R target. If, however, you entered under here, let's say you entered right here on this failed breakout. So your entry is here and your stop is here. Now your target is here. How did you manage that trade? So you understand, if you're going to be doing pattern research to develop your own book of patterns, you got to figure out, is this 1 or 2 breakouts, and how do you what would you realistically have done in terms of trade entry? I'll tell you, for me, I don't know that I've traded either one of these, but if you made me take the first one, I would have absolutely had a losing trade, because I'm not at all about holding a short against garbage like that. Now, I might be in looking at a second entry there or something like that. So definitely worth thinking about that a little bit. It's also important to think about where breakouts fail. And there are 2 broad places. They either fail, if you have your breakout attempt, they can fail on the breakout. Well, let me draw that one here. So they can fail on the breakout. So there's a breakout failure that happened here. Or they can fail on the first pullback following the breakout. So you had a successful breakout here that then transitioned into a not successful breakout. This is very important. It's very important when you are training your eye to look for these. And this is really the difference between a failed breakout and a failure test. Most of your failures on the actual attempt are going to be failure tests. As I said, they might be reversal complexes, as we have here with this next example. It's kind of nice examples. And I did not fish for, I'll tell you how I found these examples. I didn't go through, and you'll notice that these examples, some of these examples are kind of ugly. And the reason is because I didn't go out there with the idea of saying, let me flip through 20 charts to find a perfect example. I said, I'm going to look at this market. I'm going to find an example here in recent action, and if it's a little bit sloppy, so be it. I want you to see the reality of these patterns and how they diverge from what's in a book. This is, and the reason is because you might be cynical, and you might say, well, when you write a book, you're just going to put the best examples in the book so it looks better than it is, so the book sells. Maybe sometimes there's a component to that, but there's also the idea that when you write a book, what you want to show people are the best examples. Like when it looks good, this is what you want it to look like. So this is what you want to program into your mind. But then you have to go through this process. Trading is learning to trade is largely a process of becoming acquainted with disappointment in different ways. And I say that at least half jokingly, but there's a pretty big element of truth to that. So this is that's one of the things I hope to do in the Hudson sessions here, is to show you disappointing patterns that are, not necessarily disappointing, but the complexities that exist and when you start to actually apply these things. By the way, think about disappointment. And this goes back to, I told you I'm going to keep dragging you in circles around this stuff that we've already covered because it's so damn important. But let's think about this from the idea of intentionality and from Wyckoff's, participants in the market. So imagine here that how do shorts feel in this day? Really good, right? Forget everything that happened after. You just look at this breakdown. This is a successful breakdown entry, and it looks like the market's going to collapse. How do those same traders feel on this day? Not so good. How do they feel on this day? Pretty bad. So this is a really subjective and emotional and soft way of evaluating patterns, but I think it's important to think like this because, to think in terms of chart stories is one way to think about it, because these do shape your thinking and make you sensitive to, whether that's the reality of the market or not. It does teach you emotionally how to read these patterns, and that's part of building perception and intuition. Here is another example. Oh, that line's not straight, is it? I now see that. Here's an example of a failure at a breakout point, and not a great reversal here. So not every breakout failure is going to be a failure test. Many of them are. This is an example of one that is not. Is this a reversal complex? Not really to my eye, but again, we could argue about that. Just another good example. Here is a example of a failed breakdown, but this also, look at pattern overlap. So this is 3 pushes down, which we've talked about in many places. This market is overextended, free bars, that's Tesla on the daily chart. But eventually you have this gigantic reversal at the bottom, and then it just doesn't look back, just trades higher. Now, again, this is a dangerous example because if you see this, you think this is what you expect from every breakout failure. It's one possible outcome. It doesn't happen every time. You really need to define your expectations here and just continue with Tesla. So here is a breakout, and here's a breakout pullback, and then here's an extension. Now, I ask you, is this what is this pattern? What's going on here? So let's consider different ways we could define this. We might define this as a breakout failure because we tried to break out here over these are daily bars, so it's like 2.5 weeks, and then we had a pretty big reversal down under, nasty gap failure. Ouch, that hurt. So is it a failed breakout? Well, maybe, but I would also point out if you were trading this breakout, so here I'm saying if you're trading in the upside direction, long direction, this trade probably hit your 1-hour target before this collapse. So this, believe it or not, I realize this looks like garbage on your screen right now, but this could very well have been a successful breakout trade, could also have been a pretty good example of a breakout failure. And this is why you got to define how you are going to trade, how you see the market, and all of this. So many people look at this kind of work, particularly systematic people, and they say this is so subjective, it's useless. It's not, but it's not very useful until you start to internalize it and make it meaningful for you. You see the point here? And guys, I would not be spending days here talking about this stuff if there wasn't tremendous value here. So if you're, and I know some people particularly watch this on the replay are going to say this is like so squishy, you can't really do anything with it, but you can. Look at this here. So consider the action here. Few lessons here. This is little consolidation at the breakout level, and I will say breakout also to the downside. This is a point of terminology. Most stock traders will say breakdown for a breakout that goes down, but I use breakout in either way generally. This is a downside breakout. Here is your first breakout pullback, and then here's your breakout failure. And notice after, so this potentially becomes examples of both, but if we just think of this as a breakout failure, then here's a trade that really doesn't give us very much satisfaction. However, you do get a bit of information from price rejection here, right? which maybe informs your thinking of this. See how this works? You got to have all of this that fits together. It's really easy to get, if you, some people, I try to point out some of the errors in learning this stuff. People get very concerned with how do I categorize this? So going back here, is this a breakout trade? Are we looking at flags or pullbacks there and there and there? Are we looking at reversal complexes? And the answer is, here's a reversal complex, right? The answer is, yes to all of these things. And you do need to be consistent, but things can be, and in fact, many times are, two different things at the same time. And I don't think it's productive to get too lost in the nuance and the details of the patterns. Edwards and McGee, the authors of what's considered to be the Bible of technical analysis, this I think is their glaring error, which is repeated everywhere. And if you want to dig into this book, again, this is the book that most people and most training programs and certification programs lean very, very heavily on this work. This is written by two guys who were failed traders. They never made money trading. And do what you want with that. But I do think it's, rather than getting lost in the details of the pattern, it's much more important to understand what is going on. What is the market trying to do? And that's what I highlighted in that earlier thinking about that. We'll come back to that a little bit in a moment. One of the more persistent lies about breakouts is that the breakout level matters. So people will say that if you have a market setting up a breakout, so this is now defined, let's say we get a really good setup like that, right? This is now defined a pretty clear breakout level there. So once the breakout happens, now people say you got to put your stop here, because if it comes down to the breakout level, it's going to fail. At the risk of sounding arrogant, I can't imagine how anybody who has really looked at this pattern could say that. It's baffling to me. And if you doubt it, if you doubt what I'm saying, you should do the work yourself. Just look at, you'll convince yourself with 20 breakouts probably. You don't really have to do hundreds of these, but there's no value in placing the stop at the breakout level. You will see with a market making a breakout and then making a pullback back toward that breakout level. Whether it goes through the breakout level or not has nothing to do with the trade outcome. It has the advantage of being obvious and convenient on the chart, and you can make a rule and you can tweet about it, but it doesn't mean it's a good idea. And again, don't trust me with any of this, because maybe I'm wrong, or maybe like I misunderstand it in some way. You got to take this as a departure and do your own work. High level summary for breakout failure. So we're not looking at the precise breakout level for trade management or stop location, particularly for successful breakouts. You got to define your expectations in a trade. What do I mean? Let me say that another way. You got to define the profit that you're expecting from the trade. That's maybe the way to think about it. And when you think about defining a working or not working trade, breakouts fail with a failure at the breakout level. This is not a contradiction, by the way. I know I said the breakout level doesn't matter, but this is for management of the pullbacks that happen after there. The dynamics around the breakout level are critical for the failure test at the moment it happens. There's a difference between at the moment it happens or following that first successful move. They also can fail with the first pullback following. And if I just realized this sounds like a contradiction, but I hope I made it clear. If I didn't make it clear, ask a question, tell me to make it clear. So I've said pullback like 1,000 times, right? Probably be good to understand pullbacks. Pullbacks, they're relatively easy to identify. They're a relatively high probability trade. Pullbacks certainly can lead to big extended moves. Pullbacks have the advantage of keeping you focused on the trend. I'm not saying that we should be slavishly tied to the trend or only trade in the direction of the trend, but by focusing on pullbacks, it's going to keep us oriented with those. It's going to keep, one side in the market wins, and eventually the other side will win. But the winners tend to keep on winning for a while, maybe one way to think about it. And if you focus on the pullbacks, you're going to force yourself to be aligned with the winners. Pullbacks, when they do fail, and they certainly do fail, they fail in predictable ways, which we're not really going to talk about today because we talked about them earlier. There are 3 common pullback failures that we covered in some detail earlier. Negatives for pullbacks, it can be a little bit difficult to know where to put the stop. We'll talk a little bit about that today. Precise rules for entry. I would say most people learning to trade probably should focus on pullbacks, at least for your initial contact with the market. And you can figure out like what speaks to you and how you want to trade. But this is such a powerful, useful, good pattern that it really makes sense to orient your thinking around pullbacks. However, the aspect that most people struggle with is exactly where do I get in? Where do I get in, and how do I deal with a trade that doesn't just work like magic? Because a good deal of them don't work that easily, and then you have to deal with some of the trade management issues, which we'll cover a little bit here in just a few minutes. This is the quintessential trend continuation trade. I like it. I like it a lot. And one of the reasons I like it is because it's a trade that has a natural balance built in, a balance between buying trend strength. You don't want to be, I don't think, you don't want to be one of these people who's looking to buy something like this with the idea that it just gets cheaper and cheaper, and you're going to keep buying more, and then you're going to hope when it reverses enough here that you've averaged in enough that you make a little bit of a profit on a little pop. That's a difficult way to trade. I would much rather trade with the winners, but I also know that what can happen is the market gets like this and you don't want to buy here because then it collapses. You want to avoid those climactic points. And if you trade pullbacks, it's going to be automatically built in. Both those things are going to happen. There are tons of variations of pullbacks. We could talk about these all day. They do not matter. And what you want to do is to think functionally. So I talk about functional technical analysis. Now, those of you who know my background, that I'm a trained classical musician, composer, some of you also have that background, and you know where I stole this term. We talk about functional harmony, functional analysis in music, and this is the idea that there's a vocabulary which nobody's taught you. If you're not a trained musician, nobody's taught you these rules, but it's built into, it's so much a vocabulary that it's natural to you. When you hear certain things that you expect certain things to follow. This is what makes music work on a very deep level. It also applies to the market, that if we look at patterns, and if we focus less on saying, oh, is this my bear tail cup in the handle, or whatever stupid names we make up for patterns. I make up a lot of stupid names for my own patterns, by the way. If that's less important than saying, what is this pattern trying to do? So if we think about these things in that context, a failure test is attempting to reverse a trend. Attempting, who's trying? Yeah, these groups, right? The Wyckoff's composite operator, or you can say like the bears or the bulls. You can just say that. If the failure test fails, the trend very likely will continue. Of course, sideways, failure. Ongoing failure is always an option, but generally speaking, if a failure test fails, somebody tried to push the trend against the trend, they lost, they're probably going to lose relatively big. Pullbacks and all variations are trying to continue a trend. And if you understand this is, and you tie this in with the way of reading the market, thinking about intention, this is going to build a sensitivity in your own framework, so you're going to understand what's happening in the market a lot more. Why would you bother to do this? Well, it does point to an intention behind market action. I make the claim, and we've talked at some length here in the Hudson session, that a lot of what we see in the market is random, and it is. I'll die on that hill. A lot of what we see in the market, perhaps most, even at times all of what we see in the market, is essentially random garbage. And however, it's not all, right? Not everything in the market is random. And there certainly are times where there's very clear intent. And if you understand that, then you're going to be sensitive to that. It also gives you an understanding of pattern resolutions as intent rather than predictions. Now, maybe I'm being philosophical here. Maybe I'm splitting hairs, but I know the way that I learned to trade initially was I learned these patterns, and I learned that when this pattern happens, I expect this to happen because that's what the book says. And so, the pattern is a prediction, the head and shoulders, which is one of those bullshit patterns out there. We'd be better if nobody ever said that phrase again. The head and shoulders pattern predicts this is going to happen. Well, it doesn't really. But if you understand that these groups in the market that are fighting in every moment, and they have intent and desired outcomes, of course, I'm revealing my bias as somebody who aligns with Wyckoff's thinking quite closely, but I find it's a very useful way to think about patterns and about the market in general. It also takes away this need to focus on the details. Sometimes the details do matter, but the functional context matters a lot more. And I find thinking functionally probably the biggest thing for me. It is a constant guard against hubris. It reminds me that there's a lot more that I don't know, that everything I do is just a slightly weighted coin flip, and it keeps me from getting stupid. So it's a very useful way for me to think, and if it's new to you, I would encourage you to start exploring that, see if it might be useful to you. Pullback setup. So market must be trending. Ideally, these examples of reasons we might look for a trend to end. Norbert listed some of these: overextended climax, free bars, various kinds of momentum divergence. These are not present. So, we really like new momentum, and new momentum that holds together, and what we call a reluctant pullback. Seems like a weird thing to say, right? But maybe not so weird now that I've talked so much about subjective things here. But we really want to look for a pullback that feels like it just doesn't have a lot of conviction. You can quantify this if you want. The pullback generally has lower volatility, smaller swings than the things that set it up. And then several triggers are possible. You can use breakouts to trigger into pullbacks. You can use different time frames. You can make this very complex, but you need to be very consistent. So that's a matter of evolving your own trading approach. Stop location. This is a problem with pullbacks, but it's a problem you can solve pretty quickly. So you have two broad choices. Remember, everything's a trade-off. You can use a stop that my intent here with the red and the blue line, just to show you two stop locations. So you can use a stop that if we were looking to enter, think about it like this: you're looking to enter after this white bar. So if you're looking to enter after that white bar, you can put a stop just at that low, or you can give it a little bit of room. My default is something like this. And the reason for this is if you use the red stop, you're going to take a lot of 1R losses. That's okay, because you're also going to take a lot of you're going to get a lot of 1R wins on the other hand, right? Your target's going to get be quite a bit closer. But there's a little bit more risk with a tight stop of having a gap against you that leads to a larger than expected loss, and I don't enjoy that. Like one of the really bad things that can happen is, let's say you're risking aggressively 3% of your account per trade. That's pretty aggressive. It's really aggressive, and you happen to have a 4R loss, like it's a gigantic gap against you. It will happen. I believe the largest loss of my career was on the daily chart was something like a 4.5R loss. It was Yahoo back in the day, and it just gapped way beyond the stop point. Shit happens, but shit can't happen very often like that. And if you are using very tight stops, it's going to happen a lot, and you're going to have a number of losses that are bigger than 1R, and you're going to have some like 8 and 9R losses. Now, maybe you can get away with that by reducing the, you could adjust your position size to compensate for that. But I like the little bit of protection against this by having the wider stop. So if you just look at some of these examples, and you'll see there'll be plenty of times looking for pullbacks that had really bad gaps in them, where really bad things happen. And what you will see is, if assume that I'm at the blue stop level, If I have a 3 or 4R loss, I'm very, very unhappy. But somebody using the red stop level might have had like a 12R loss, and they're much more unhappy. And that's so that's something to consider. But anyway, these are the kind of the two possibilities for stops. I don't think with a pullback it makes any sense to use a stop in there because the dynamic's a little bit different. So look at this pattern. Where would you put a stop? So there are two possibilities, right? We could put the stop right under here. That's not touching that low, it's a little bit lower. Or you can put a stop under here. Now, if I page forward a little bit, what you will see is my higher stop was here, and they still got us. So this is a complex pullback, which is one of the joys, and I say that not humorously because it's not a joy at all. This is a pullback that begins and then makes a deeper pullback, and it stops everyone out there. These are quite common. It's a two-legged pullback. One way, here it is in swing structure, looks like this. They're very common. They do tend to occur later than trends, or later in trends. It's a little bit unusual to see when you have a breakout. So you have a breakout here, and then you have this move up, and you have this first breakout pullback. It's a little bit unusual for that to be a complex pullback. It can happen. It's much more unusual for that initial pullback to be a simple pullback, and then for subsequent pullbacks to be bigger. One of the other places that you will see complex pullbacks is after a climax. So if you have a climax, you're likely to have action like this, that then if the trend continues, you had several fake outs here. It's like it takes more time. The market has to do more work to absorb the overextension and the climax. These can lead to great moves. So I think as a pullback trader, you would have a bit of a difficult time if you said, I'm just not going to participate in complex pullbacks because I hate them and they make me mad. That's where a lot of people start out, but I would encourage you to put a little bit more attention back on them if you have done that. Just some examples here. Again, I deliberately did not pick clean examples. Here's a complex pullback in the 10-year treasuries. And this is one that we got in our we got this short in our market life work, and this is now setting up a nested pullback, which is coming next. Here's maybe a little pullback. Some of these have quite a bit of velocity against them. So these are kind of ugly examples. Like I said, deliberately. Here is a complex pullback in crude oil. So the thing about a lot of these complex pullbacks is that they will go long enough. If you trained yourself to think that pullbacks work like this, you will tend to say this is a pullback. And then once you get into this, it's too deep, it's too much, I'm going to stop looking for it. And that's not necessarily true. You get some really great moves. Like look here, this is a great simple pullback. This is what we expect as a textbook pullback. And then you get here and you get this bigger pullback. But look, there's your simple pullback. This is just what I told you. Here's your complex pullback. So that's what I was saying, where the complex pullbacks tend to occur a little bit later in trends. Another trend example here from the Japanese yen. Complex pullback there. Complex pullback here. Complex pullback here. It's a little bit spiky for a pullback. I wouldn't necessarily be looking there. And you might even, same thing here, but all of this would resolve into a higher time frame pullback, perhaps, probably. Yet another example here in Chewy. And I drew a lot of these from our market life trades. That's where some of these crazy looking markets came from. But here's a very tradable pullback, even though it's the lesson here is this is a very extended trend. But if you pullbacks can give you a way to get into these trends that are extended without, you don't want to short here. That's a hard short, right? That's what everybody wants to do. Sometimes you get away with shorting here and it just continues, but more than likely, if you're trying to short into these extensions, you end up with not what you really wanted, but waiting for these pullbacks maybe here. This one really wasn't tradable, but those will give you good trades. Let's talk about nested pullback a little bit. So I did mention this in the book, but this has become much, much, much more of a focus. It's not really a pullback. So the idea here is you have a pullback. So you have a pullback here that looks like this. But then what we are doing is we are looking in this area of the pullback. So you're looking for once the pullback starts working, and you're looking for any pause. This pause might be, it might look like this. You know, you might have another little mini pullback. That's one. You might just have a little bit of a sideways thing. That's possible. You might even have here, like, so now I'll switch to bars. You might just have like a single inside bar. But what the idea is, once this pullback starts working, so you got to wait for the pullback resolution to happen, then you're looking for any kind of pause that you know, gives you some reason to look to enter in that direction. And here's an example you saw before. This is that pullback in Berkshire. So another way to think about what we identified as a failure test before is the subsequent action. The failure of the failure test can then be read as a nested pullback. Now, I've deliberately shown you a pattern here that we've read 4 or 5 ways. And if you're scratching your head wondering which is right, they're all right. This is all the correct way to look at it, but just showing here, this is a good example of a nested pullback. It's not a great example because it's a little bit close to what straight line, please. It's a little bit close to what I would consider to be the target for the trade, right? This might be a more attractive nested pullback, something like that. Here's another example of a nested pullback in DIX. And yes, you can trade following a gigantic gap like that. Like, I mean, that's kind of a holy shit situation, right? You don't really want to be looking to short in here. And in fact, most people are going to be probably looking to trade that for some kind of bounce. But, and it's not a bad trade, but look here, once you see the emergence here, and then you see this little consolidation here, starts to tilt the scales for at least a retest of that low. Another nested pullback, gold. So here you have a kind of ugly complex pullback. Look at that. It's not a nice pattern, but and these are not examples I'm just pulling out for this presentation. These are things we identified in real time. So, and you should be asking that question. You should say, well, awesome, after the fact, could you identify it in real time? Answer is yes, you can. A lot of these pullbacks don't look very good. They have too much counter trend momentum. They go too far. So this pullback went too far to be a good bear flag. So did this one, obviously. But even with that, then they still work. Stock indexes are famous for this to the upside. You'll see long setups, and then they'll go down. So, you know, they'll just go sideways. And maybe this is what's happening right now. I don't know. You know, when I was making this presentation in the middle of the week, I was going to make this argument for a pretty bullish near-term case for stock indexes. I think Friday's action might be a little bit more challenging, and you know, we'll see. September's obviously a bit of a tough month for stocks generally, but it's also characteristic of persistent trends, and markets that tend to trend very well will have these kinds of pullbacks. And when you do have this, when you have these kind of shitty pullbacks that you really can't get into, you know, I'm not suggesting that it would be a great trade to look to short here, but perhaps once you identify that there is some downside momentum here, then maybe a nested pullback becomes a little bit more interesting. Same thing here, you know, would you short here? Yeah, I guess you could, but really makes this much more interesting. Give you a good entry, can keep you from trying to deal with things that are crazy extended. And again, there's a lot of overlap. Here's Coco. What's going on here? Is this a breakout? Is this and I know we haven't talked about breakouts officially yet, but is this that situation where you have the consolidation under the breakout level? Yeah, maybe. Is this a, so is it, you know, then is this a breakout? Is this a wedge Well, I mean, yeah, probably. Is it a triangle? Probably. I don't really care, because functionally what's happening is that this is some type of consolidation around a previous level, and the level is kind of a big zone there and putting pressure on it. It also could be read as a nested pullback following the upside break of this. And this is a pattern that's happening in real time. It's not, look back analysis. Snap pullback, or the ante. So this is a pullback variation. This is a very important trade. Attempts to grab the first consolidation following a potential trend change. Sequence is some reason to think counter trend, some kind of extension, climax, 3 pushes, the things that Norbert listed earlier, overextension, free bars, and then a strong counter trend pop, which is illustrated here. So what I've done here is illustrated basically a not impressive new high, and that's some reason to think maybe we could have a short. But then we don't try to short that. We wait for strong counter trend momentum, a reluctant attempt to resume the trend, and this then turns into a pullback into a bear flag here, and then we're looking to trade to the downside. This is the sequence, 1, 2, 3, 4. And this trade, as it's usually taught, is called an ante, and this comes from the 1996 book Street Smarts, Linda Raschke. Good book. You should read it. You should be familiar with the things that are in there. Some of them don't test out so well, but that's the danger of putting clear setups out. Sometimes they're not robust for decades, but the concepts are very, very solid. And the concept here was based on an indicator. So you wanted to see that basically what you wanted to see, you had an indicator that measured kind of intermediate term momentum, let's just say longer term momentum, and then you had a faster momentum measure. And what you would look for would be a case where the longer term momentum had just rolled down and the shorter term momentum rolled up against it. So what this was showing you was the shorter term momentum was in conflict, anti the longer term momentum. And in that situation, what you expect is for the longer term momentum to win. And that's the concept that is behind the name ante. Problem is, it's a really useful idea, but I don't think that captures everything we can see on the chart. It will miss trades. If you just test that indicator pattern, you're not going to find an edge, nor was it really intended to have an edge. But the indicator can be useful structure while you're learning to trade it. I think it's more important to go to the price structure. Also, the character of the resolution. The nice thing about trading these is that when you get these that work, they work really well. And so that's where we came up with the idea of the snap for the name, because they're usually very quick trades that are nice to be in. Work on all time frames, of course. And as I stopped using the MACD, it's still on my charts because I think it helps people to see things sometimes, but I don't even remember the last time I looked at an indicator for a setup. So we renamed it because the ante name became a lot less meaningful, and it was much more important to focus on the price action, what was happening. Here's an example. So this is the S&P from mid 22, and we did have a bit of an uptrend, and not super impressive. We had several reasons here for being suspicious, 3 pushes here and then a subsequent push, a little bit of action here, which is mildly climactic. No one's saying to short this, but this is because this could very well have turned into a slide along the band's trend. Instead, so we're aware that's a reason to watch for end of trend. Instead, we got sharp counter trend momentum. Now, one thing the MACD will do for you is on that sharp counter trend momentum, it will show you a new low relative to recent price action. So this gives us reason to look for and to think about a possible short. And then, actually, I'm sorry, I drew those lines in the wrong place. 1, and then really 2 is over here, because 3 is the pullback. The bounce was then reluctant, and then we have the clean counter trend momentum. And you can also see here, here's the trade Actually, this trade isn't set up by the end. I thought it was, but when I look at it, I believe the indicator lags enough that we did get this anti-move in the indicator, but it probably wasn't super useful because I think it probably triggered somewhere in here. I may be misreading the alignment. Yeah, maybe it's more useful. Anyway, that's the concept. That's a pretty good example. These don't all work. Sometimes they lose, and when they do lose, this is an example from early 2020, we typically get a little bit of trend continuation because losing snap pullbacks. So I'll show you here on a slide in a moment. So you have a market that's trending. You have a snap pullback that doesn't really go anywhere. What do you have? What's that look like? Now you have a complex bull flag. So you're likely to see some trend continuation. So definitely has implications for trade management, but here's a moderately good snap pullback setup that led to complete disappointment, or did it? Here's the subsequent action, and now, this is the COVID crash. Is this a snap pullback? I don't think so. Do notice you have very clear, so, if you kind of follow through the steps, you had reasons to think maybe we were running out of momentum here, running out of steam a little bit. You had counter trend momentum. Actually, you had counter trend momentum that is so far off the charts that you need to be aware that maybe something abnormal, severely abnormal is happening here. This is a reluctant bounce. Now, this is a reluctant bounce where you covered 250 S&P points in the space of 3 days. That's crazy volatility, but you just sold off 500. So in context, proportionally, that's a relatively reluctant bounce. So I would call this more of a simple bear flag. And nothing simple about this, but I would call this more of a bear flag than a snap pullback. Stepping forward, just you can see here's this action here. That's the same thing we saw on the previous chart. Now you have a lot of stuff that looks like it's bottoming. And now you have new upside momentum. See this? New upside momentum here. And if you couldn't see that, the MACD makes a new high relative to its, so, I'm not saying the indicator is useless, but you also can read this on the price structure. So this is now a potential long setup, which, I'll admit at the time, I did not see, but it's obvious in retrospect. And you won't see all these things at the time. One thing to be aware of with the snap pullbacks is the measured move objective. So you have here what we're doing, and we also covered this in previous Hudson sessions, but this move is very often the same as the setup leg. In this case, we got much more here, but it's a pretty good place to look for a target. One thing I would be careful of when you're trading these, let's just say that you were smarter than me and you got long here, and you would have been aware when you got long here of where your measured move target was here. If you see that your profit target, just depending where you put your trade, where your entry is, that your profit target is far above that measured move objective, or even a little bit above, I'd probably adjust that, because chances are this first move off of the snap pullback is going to run into a little bit of trouble around the measured move objective. Here is a snap pullback that failed to reach its target. This is later in 2020, September 2020. Look, so climactic, there's your 1. Clear counter trend momentum, there's your 2. MACD fast line makes a new low relative to its previous, and then a reluctant bounce. This is a good anti setup. This is a good snap pullback setup. And where's the measured move objective? So you're looking at here, and then measuring it off of here, I don't know, just eyeball it somewhere down here, didn't get there. So they certainly don't all get to their target, but this was a reasonable expectation for the short, even if it wasn't reached. Here's another example of a snap pullback. 1. So here's 3 pushes. This is our reason to think counter trade. Here is our counter trend momentum 2. Notice the MACD fast line makes a new low. Does that sound like a broken record? I hope so. Now, this is maybe not the best anti-snap setup because this is not really a reluctant bounce. It's okay, but it's really not great. And you can see the follow through here in 2 bars is kind of disappointing. Why is it not great? Because I would not characterize this bar and this bar as a reluctant pullback. We very quickly retraced more than 50% of that previous swing in 2 bars. So that's some pretty good buying off of that low. Still, you know, you could have thought about a short there, but you definitely needed to be sensitive to the fact that you didn't get much follow through there, because when that happens, that bar is this bar. When that happens, you're much more likely to see some trend continuation. Note the reversal complex, and note that this probably resolves as reversal complex too. I already touched on this. Snap pullbacks are potentially elements of complex pullbacks. This is a good snap pullback short, but if even when it hits its target. And here's we don't get a chance. I said trading's constant disappointment. It's not. One of the spots where you get a chance to feel really smart, and this happens enough that it's worth mentioning. Let's say you're setting up a snap pullback short here. So what you'll find many times is because you listened to me and you set your target inside of the measured move objective, so you will many times have the experience of getting short here, taking your profit here, and then looking at the market rip higher after you took your profit. So, you know, you're definitely kind of, it turned out you were trading counter trend to the longer trend. You didn't know that at the time because honestly, you know, that might have been an outcome. It wasn't, but you still took a nice short chunk out of this leg before the market turned around. That will happen. It feels really good. You feel really smart. You look really good when you do it. So you should tell people when you do it. Actually, you shouldn't, because you know that will build something in your brain that's not so useful. But you definitely need to be aware of that and the possibility of this resumption, because it can be really ugly, right? Like what if, you know, imagine you got short here and you were short and you were so convinced you were short that you didn't get unshort, and now you're holding this gigantic thing that's trending against you, and that's very, very bad. You don't want to do that. Managing these trades, 2 structural factors. Measure move objective is important. It's not sacrosanct. We will go beyond it. It won't be hit every time. It's a good guideline. It's a good enough guideline that I, generally speaking, will not have a target beyond that measured move objective, because I'm looking to take 1R on these. Failure of a snap pullback can lead to large scale trend continuation, which means that you have a losing trade and you're on the wrong side of a trend. Now, this is specific to this situation, so please don't go and say Adam said never add to losing trade. Adam sometimes says add to a losing trade, but where you don't want to add to losing trade is when the market is, when it's a trend trade and you're on the wrong side. That's how you will get absolutely fucking crushed. So if you are on the wrong side of a trend, never add to that trade. Respect stops, of course. It's kind of saying the same thing, right? You can use reasonably tight stops on these, but there is, of course, a risk that, like, you know, if there was a weekend or something, there's a risk that you got short here with a tight stop and it gaps up here and you have a larger than expected loss. It will happen. It doesn't happen a lot, but these are because of the kinds of market dynamics that are wrapped up in these snap pullbacks. This can be a point where that happens a little bit more often. You might want to consider taking your full profits at 1R. Okay, folks, another 5-minute break. I guess it's another good time. Either stretch your legs, ask questions, type questions in the chat box. I'll start with questions and then we will wrap up. The end is in sight, I promise. Okay, here we go. So breakouts. We have really kind of already covered this in a sneaky way, but just to talk explicitly about breakouts that work. Pros, they're pretty easy to identify when they happen. It's very important to understand breakouts because they're an element of many other patterns. As for instance, one of the great ways to enter pullbacks. Breakouts certainly can lead to explosive moves, and they keep you aligned and focused on key market structures. Now, negatives for breakouts, they're not always easy to identify in advance. So you can't say with perfect reliability that this is going to be a great breakout that's happening here, or even sometimes to say there's a potential for a good breakout. Good examples on a pure pattern basis are relatively rare, much rarer than you would think from looking at trading books, which show you, piles of examples of breakouts. They can really be complex to manage. We talked, we really covered this already with the pullbacks following the breakouts. And one of the real negatives with breakouts is when they don't work, it can get really bad really fast. And so this has a lot to say about how you need to manage these trades. They do fail frequently, and some of your biggest losses as a trader are likely to come from the dynamics around failed breakouts. Let's think just a moment when we think about setting these up. It's all about price acceptance. So lack of price rejection tilts the scales toward the probability of a level breaking. And if we're looking at a chart, subjectively reading the chart, we will see this as pressure against a level. And you can see here higher lows into a level. Also, you can see things like this, what we call a breakout base or smaller consolidation up against the level. You can see individual bars in these cases. It's not on this chart, but if you were to zoom in and look at individual bars, you'd probably see a lot of bars here that have tails in the downward direction. So a lot of individual bars that look something like this. And what we're talking about here on the chart, on the page really, is the bigger picture swing structure. Now, breakouts can be, even if you don't trade them, you need to understand them because this is one of the ways that you learn to read markets. What's happening here? Well, so let's come in kind of mid chart. So let's start reading from this area to the right. So you have here, we're obviously in some kind of range, right? You're pretty clearly in a range, but this range sits in a bigger range. And that's very interesting. This range sits in a bigger range, and I would be aware that this level was kind of an area where we had a failed breakout before. We couldn't really get up there, right? I wouldn't truly call it a failed breakout, but I'd be aware that this is a level I need to watch. And we keep engaging this level, and the bears don't get anything from it. Look at this. We keep, once we come away from that level, we're right back there. So this is very likely setting up a breakout. If you miss the breakout, look here. Then you have this nice pullback. Then you have another nice pullback. Look. Simple pullback here. There's some structure in there, but this is much more of a complex pullback here. Bigger pullback, eventually a topping formation here. Another example here is a breakout from early summer here. You might also say that there's some overlap here with a nested pullback, right? Similar concepts, but just kind of a standard example. These trades can be very, very complicated. Look what happens. You have first this trend ending into this previous level, and you've obviously set up some kind of big level here, and then you're back here. But the idea that you're going to execute a trade when like this precise level is broken or this precise level is broken, I think these are much more useful to me as concepts. It's a very important trade to understand, but from the conceptual level, rather than I'm going to go push the button on a breakout trade. Now, we should also point out that some people have definitions of breakouts that are so wide that they're, I would say the definition is basically useless. So, like some people say that every move is a breakout of something because you're breaking out, previous bar's high or the high of X days ago or something. It's not really that useful, right? What we're talking about here are these key structural levels on the chart. I just want to point out here, how ugly is this? I'm so proud of myself. I found a really, really ugly breakout example. But just imagine that you were a trader trading breakouts, and several things here conspire to make this difficult. So you do have pretty clear price rejection from this low. Look, every time you touch this low, what happens? You pop back up into the middle of the channel. So there's not, it's obvious that we're not hugging that bottom boundary. So you're not setting up a breakdown trade. But I don't know that I would say that this is real clear consolidation up against that level. This is for solar, by the way. I assume this move was made on earnings, but you did have an opportunity here to trade in a flag here. Here's a flag here. And then look, nasty failed breakout there. Not a terribly impressive successful breakout to the downside. So this is a really ugly chart, but it's important to see some ugly charts and to think about the difficulties of managing trades. And I guess one of the other lessons that's kind of built in here is that if you, and this is not the trade we're talking about, but let's say that you were like, one of the supply demand traders who thinks it's a good idea to short here. And of course you had this gap. Now I'm guessing that's a trade that nobody in their right mind would have made because again, I don't know, but I'm assuming that's an earnings gap. Nobody's going to short at a resistance level the day before earnings. Like that's suicidal. But if you had done that, let's imagine you'd done that with a tight stop. Here's an example of how you have the opportunity to experience, if you want, a 6, 8, 12 hour loss because your gap beyond would have been much bigger than expected. We don't really need to dwell on this, but make sure when you're doing this pattern work that you don't just zero in on the really nice examples. Don't just pull out things that work very cleanly. Spend some time thinking about what your experience would have been like trying to trade some of these difficult charts. And I'll also say, this is a stock that I know pretty well. If I were inclined to do a bunch of breakout trades on a daily chart, I would have known that this particular stock or market, if you trade currencies or futures, this applies broadly. I would have known this is probably a difficult market to try to trade that way in. So what I'm saying is I think that this was largely avoidable. How do you simplify breakouts? Well, not going to spend a lot of time here, but you do need to think about what outcome you expect in terms of your risk. And that's what the R multiple stuff is about. And the same two broad divisions we discussed earlier, either playing for a small target or for extended trends. I don't think you can be both. And if you do both, you need to do both explicitly. But what I mean when I say you can't be both, you can't be a trader. It's like sometimes I'm going to take big wins, sometimes I'm going to take smaller. You really do need to be consistent because those two approaches take a very, very different mindset. And if you don't know what kind of trader you are, you're going to spend a lot of time spinning your wheels and working against yourself, fighting yourself. Time frame, of course, matters. And when I say this, just to be clear, I don't mean that your choice of 5-minute or hourly or daily or weekly matters. What I mean is that you're very, very specific with the time frame that you focus on. Now, having said that, if you do want to trade clean breakouts, I think the people who make the best use of these are probably intraday traders. And in my intraday trading, you will see clear levels more often. You will, and one reason is because you have very visible things like the high and the low of the day that everybody can see and everybody works against. So you have these levels. On the daily and weekly, the levels are a little bit messier. You do want to be suspicious of obvious trades, and meaning that if you see something setting up that's very, very obvious, be sensitive to the possibility that the obvious resolution might already be kind of priced in, and a lot of people are prepared to trade against it. So we are sort of heading into the end of the presentation here. I have another major topic to talk about, and then we'll wrap up. So this is a good point. If you have questions, type them in the chat box, because I want to make sure to get to them. Structural trend change. So I will tell you what this is. This is essentially, okay, no, let me say this a different way. I should have rehearsed this. The ante is the snap pullback, is this structural trend change playing out on a shorter time frame. This is something that we find ourselves thinking about internally here on a conceptual level. And the other way to think about it is to kind of flip that around and to say that we take the dynamics of the snap pullback and we apply them to longer term analysis. So you're going through those same steps here. And you have, number one, some reason to look for a trend termination. I'm going to flip back and forth between these charts. So that's what I'm illustrating here with number one, that's a move. We came from an extended trend. So, there's one thing, the trend's been going on for a while, and then it goes a little bit parabolic or climactic. That's what I'm illustrating here. Of course, there are tons of other possibilities. And then we have the emergence of real counter trend momentum, which I'm just showing by a sharp move down here. We have a failed attempt to resume the trend. Now, this is where it diverges a little bit from the snap pullback, because in the snap pullback world, I'm looking specifically for that pullback. I'm looking specifically for that reluctant, crappy bounce. Like, if I go back here, what I'm looking for in the snap pullback is I want to see the bulls just suck. Like, that's all they can do. And then I'm expecting more of a quicker rollover. But here, if I'm thinking more structurally, contextually, conceptually, this number 3 point is not a super impressive attempt to resume the trend, but it can be some variation of, yeah, I'll show you in a moment. It'd be a higher or lower high, basically. And then you see the second counter trend momentum. So where does this actually get actionable? Where can you do something? So just to go through these, trend termination, actually Norbert gave us a very nice list of this. The emergence of real counter trend momentum. I do have a blog post. Actually, when you guys drop, I think just Google, hey, that's different in my name. I have a blog post that this is a very, maybe we talked about this earlier in the Hudson sessions too, but just the idea of looking for price action that breaks the pattern in various ways. So you see, in an uptrending market, you see the bulls lost control. It's just enough that like anybody looking at a chart can say, oh, look, something really changed there. Thank you. Oh, that was a pretty easy link too, right? And then when you start to look at this failed attempt to resume the trend, this could be a higher high or a lower high. So you're looking for, and again, the Edwards and McGee people will start talking about like all of these different topping formations, and they'll place great value on double tops, or whether the top goes a little bit beyond, and people will start doing really stupid shit like snapping Fibonacci ratios on it. You don't need that, because what you've seen here is that you have a trend and you have some reason to think that trend its back is broken, right? Like it's somehow damaged in some way that has upset it enough that you're not that likely to see clean trend continuation. And that has occurred in steps 1 and 2. And then you want to see kind of a crappy attempt to resume the trend. What you don't want to see here in a structural trend change is you don't want to see that the old trend is okay. You don't want to see, and this will certainly happen, like, the market will get overextended, you'll see some real counter trend momentum, and then it'll go sideways long enough. We've seen, all this ties together, right? We've seen examples of that earlier in this presentation, and then it absorbs that hit that it took and just ends up going higher. So you don't want to be involved in that, but if you want to be involved on the other side of that, if that trend recovers, but you do want to be sensitive if that doesn't happen, and it can happen through a lot of different ways, and then looking for this counter trend momentum to develop in 4. Where do you actually trade it? I think somewhere in 3 and 2. It's somewhere between 2 and 3. If you wait until 4, so you wait for, I'm going to go back here because this is just a little bit easier to talk about. So if you wait to try to trade this, barring something like looking for a small consolidation, nested pullback, looking for a small move where you're trading with this easy, clean momentum, that's a possibility. But the trade many times is kind of over here by the times you get to 4. Where it gets interesting is either if you can identify this turn or here. One of the real nice things about this is that if you build this mindset of being okay to miss the first move, this is another way, and I'm building in a lot of psychology here, because what you see when you have a market that's just trending like this happens to everybody. If you're a day trader, you will experience that you'll have some days like this, and at the end of the day, you look at it and you say, oh, the damn thing just went up all day. I lost a lot of money and I was short. How could I have been so stupid? Well, you weren't stupid. You were a normal trader. This is something everybody does. People also do this with stocks. They do it with stock indexes, trying to short all the time. And the reason they do this is because they think that there's going to be some point, of course, that it collapses, and they don't want to miss that move. So what you have to convince yourself, I believe, is that you have to be okay missing that first move. You have to know that if you have this market that's trending up and then eventually it melts down, that your goal is not to catch this first move. In fact, it's fine to miss that first move. And thinking like this through the structural trend change, this first move is number 2, right? It's not our responsibility to catch that. It's where we start really paying attention. But what this does, if you can internalize this, is it forces you to adopt an anti-FOMO, FOMO, right? Fear of missing out. So this is explicitly an anti-FOMO way to think about the market. It makes you get comfortable not looking for that first move. Rather than trying to short all the time, you would have been long, and you know that when you do get that first move, you're not going to be short. In fact, you were probably long into it and you got stopped out of your long, but now you can start thinking about the short. This also, the structure gives you a lot of insight for other trades, market dynamics. Negatives here, and there are some significant ones. This is a really complex pattern. This is so complex that what I'm showing you today when I talk about this is my second attempt to put it in this presentation. I put it in this presentation, I thought about it overnight, and I ripped it out of the presentation completely, and then I put it back in here in this format. I am aware that this is the most subjective, the softest, but I do think it's important, and I hope if it's a head scratcher, the way to make it a little bit more concrete is to go back to the snap pullback, and then to see that what I'm doing is I'm taking the snap pullback concept and I'm stretching it. I'm making it apply to a lot of other things. Think of this as a structural wrapper, maybe, to look at trend termination patterns. And do be aware, as I said, by the time we get to number 4, by the time it's obvious to everybody, the battle's already over. So just some examples of how this works. So this is, I would consider this to be 1. So 1 is, and this is gold on the daily chart from just squint here, from late 2022. So we've had a downtrend. We've had some nice easy shorts. Look at this, less easy shorts, but this thing's getting a little bit overextended. We're down, 1, 2, 3. That's the 4th leg down, and we're certainly 3 pushes. Am I gonna buy this because of that? No. But it's enough warning to say this is maybe not the best trend integrity. I'm going to be watching for 2. I'm going to be watching for sharp counter trend momentum, and then I'm going to be looking for a kind of half-assed attempt to resume the trend. This was a pretty good one, but look, we made a little bit of a double bottom, ended up being a triple bottom, and here's 4. So what this tells you is, once you start to see this kind of bottoming action, you can then be sensitive to look to take long trades when we've ground through this. Now, this is not simple, because here's another example. This is the same chart, basically. Here's 3 pushes down. So this is certainly one. This is certainly sharp counter trend momentum. This looks like a reluctant attempt to begin a trend, right? So you could potentially, I don't think it's likely, but you do have to realize, had the market evolved a little bit differently, you might have been suckered into some longs here that turned out to be wrong. You also, if you don't realize then that what's happened here is that this one has been absorbed and canceled, you could find yourself still looking for 3s. So again, there is an element of subjectivity here. This might not be that useful for anyone else. It's a framework that I am finding very useful. I'm not talking about it a lot publicly because it's a lot of, do you know Calvin ball? I think maybe I referred to this before. It's like when kids play games and they just totally make up rules that are, as they go along. Of course, it's a kid making up rules so that no one else can win. But if I talk about it, it feels like Calvin ball potentially, because it's all this oh well, and this and qualifications. But it is a very useful framework. It's my framework that I've internalized. It might be less useful for you. If you want to think about it, like I said, go back to the snap pullback and think about how you can generalize those dynamics. If you are an intraday trader, you will find good examples to trade this intraday. In fact, if you want to fade an extended trend intraday, requiring this framework is going to keep you out of a lot of stupid trades. And there are good reasons why this probably works pretty well intraday, better than on longer time frames. For longer term, I would think about it in terms of like a traffic light system. So if I look at a trend, think green, yellow, red. So a green would be a relatively new trend or no strong counter trend signs. And what this would tell you is don't trade counter trend. Or if you must, and sometimes we make mistakes or we're forced to do things, whatever, at least have a stop and never add to the losing trade. A trend where I would evaluate the trend integrity is yellow, has some warning of trend breakdown. This is somewhere between stage 1 or stage 2. You can trade counter trend here. Honestly, if you trade counter trend, you probably expect to lose. You can add to losing trade, but it's very high risk. And red means the trend is likely broken. So here you are probably later in the STR, you're like in stage 3 or 4, and you're looking to trade with the new trend. Of course, there is some possibility that old trend will come back and get you, or the new trend itself fails. But thinking about it like this, and thinking about, rather than being black and white, thinking about green, yellow, red, just to maybe go silly into the analogy there, I think this can be a very useful way to think about trends. Now, we're through the chapter. Here's the secret. These aren't just trading patterns. These trades, so the breakouts and pullbacks, are a complete system of market and trend analysis. You could build a complete religion around these things. And there's this cycle where you'd be going from a breakout, so you're in a range, you go to a breakout, then you start to have pullbacks. Eventually you have failed pullbacks, failed breakouts, and that leads to failure test and puts you back in a range. And you can see this also is this yin-yang balance between support, resistance, breaking, and holding. And you've seen this diagram before, right? This is that Wyckoff diagram that I showed you on one of the first charts, one of the first slides in the Hudson sessions, months ago, right? So look here. Here are your breakout trades. Your breakout trades will happen here. And these follow your failure test trades or failed breakouts maybe. Once breakouts start working, then your pullbacks start working. And then you start to have failed breakouts or failure tests. I'm writing failure tests here, honestly, because I can't really write on the damn screen, but it's obvious here that some of these will be not failure tests, but just failed breakouts. And then guess what happens? You have more breakouts, more pullbacks. So these are not just patterns where you can set up trades. This is an entire way to understand what's happening at the market at any moment. But danger, danger. So as I said at the beginning of this presentation, when you start learning these patterns, you're going to see them everywhere. And we've covered many variations of patterns. I spent a lot of time talking about the nuance here that goes beyond what I would usually do. Because the idea of these Hudson sessions is I wanted to dig deeply. I wanted to show you a little bit of what it's like inside my brain. And I guess, actually, maybe there should have been an apology and a disclaimer at the beginning of all of these. But so now you know what it's like inside my brain. But you do see like a lot of the conflict and the fact that this really is kind of this ongoing weighting system where it's not like this is not this. It's like this is more like this or more like this. And I think it's going to this information is potentially dangerous to you until you assimilate it and until right now you have Adam's nonsense in your brain, and that's not really going to be good for you until it's Sam's nonsense or Ray's nonsense. And then you'll have the same problem, once you've internalized it, where you will have difficulty communicating the nuance to other people. But it's definitely worth thinking about that. There's more here than you can use easily. You don't need to have all of this. You need to be quite specific about what you're going to do, but this gives you some idea, I think, of the depth and nuance that's necessary to really read the market, I think. A couple words here on when not to trade. So I began the book by saying that we have reasons to trade. We have edges, in contrast to that slide 100 slides ago, where Van Tharp said that, knowing you have to trade every day is an edge. Well, that's not really an edge. We have an edge when we have a reason to place a trade. And generally speaking, this comes when there's momentum, because the only reason we have a potential for an edge is where there's an imbalance in the market. So if you know this and you avoid times when the market is flat and dull, you're going to skip a lot of losing trades. Now, do notice this might be time frame specific. So higher time frame might be setting up a great breakout, or might be in a pullback, and your lower time frame is flat. So you're making a big mistake if you put up like 3 time frames and you say, I'm not going to trade when any of them are flat. That's a very serious mistake, but you definitely want to avoid situations that look like this. This is the kind of action where you have a market that is in the middle of a range. It's near a flat moving average. It's chopping back and forth over that moving average. You're gonna have a lot of losing trades in these areas, and if you can avoid trading. Also, now that you have this piece of information, if you go back and look at some of those suboptimal situations I was showing you earlier, I didn't really want to say it at that point because I didn't want to be like, introducing yet another piece of information, but you'll see that many of those I avoided and were avoidable just because of this rule. Just don't trade if the moving average is flat and you're chopping back and forth over the moving average, and or you're sitting in the middle of a longer term range. Now, one question you need to think about: what do you do if you get into a trade and this kind of action develops? That's a trade management question, and there are several possible answers to that, and that's an answer you must answer for yourself. Quick review here. We covered failure tests and how important reversal complexes were in that. Failed breakouts. We look at pullback variations with special focus on the snap and the nested pullback, and focusing more and more on the nested pullback. We talked about breakouts, but by the time we got to breakouts, we'd already talked about them in the context of the failures and pullbacks. And then we had a little walk in the swamp that is the structural trend change, but it's more important than I can quantify, I think, at this point, because it's a useful framework for thinking about trend integrity in an objective way, because you're taking these signals and weighting what you think about the trend. And then we looked at when not to trade. Also worth thinking, just to take a look back, only 4 possible directional trades. This is from earlier in the book. Trend continuation. These trades by and large are pullbacks. Sometimes breakouts could sit here too. Trend termination. Snap pullback is a variation of that, and I'm going to leave that deliberately. If that's not immediately obvious to you, I'd like you to spend a little bit of time thinking about it and send me a question if it's not obvious. But I think the interaction between the snap pullback and structural trend change to make that a little bit clear. Failure test, failed breakouts, obviously trend termination, failed pullbacks, support resistance holding, clearly failure tests and breakouts, and support and resistance failing. These are breakouts that work. That is the end of our adventure today. Just yet another quick call out. Again, I would love for you to check out Tradecraft. I'm going to talk a lot more about it Monday, so come and join me there. I would really love to have interested traders who are serious about taking their, we'll say things like take your trading to the next level, but it's not really that. This is a path that there's nothing else out there that nobody's done this work before in quite this way, with tying in both methodology and details of patterns with the framework of proper mindset and psychology. And then guess what? Giving you tools to do things like address limiting beliefs and build new habits. And so this is something that we started working on a few months ago. I started working on it quite a while ago, and as it crystallized into its final form here, well, I guess it's not final, it's still evolving, but as it crystallized into this form, it's awesome. I'm so pleased with what it's turned out to be and what it's doing for people. Come and check that out. Join me Monday. I'll tell you more about it. And if you want to know more about me, check out my blog, adamhgrimes.com. Twitter is at adamhgrimes, marketlife.com. You can also find my books on Amazon. Somebody asked where to find the old Hudson sessions. They're on the Market Life YouTube. I also have a blog post, which I think I'm a couple sessions behind, that has links to all of them. You can find that on my blog. I will update that blog post here very, very soon. A few questions. Bruce asked if there's a new book coming out of this new material. So I do want to point out that 2 things here. So first of all, the new material that I showed you today, I don't really think is worthy of a new book. This is my evolution of how I'm thinking about these patterns differently. I think that there's very little in the art and science book that needs to be altered or changed in any way. So that material, the psychological material, I realized I really could not put into a book. That's why Tradecraft exists. This is the all of my work on psychology and shaping and developing traders that way, including my kind of bizarre background with hypnosis, which I haven't talked about publicly very much, but all of that's finding a really kind of cool expression in Tradecraft. And so that's the new book ended up becoming Tradecraft. A couple other questions here, and keep asking them if you got them. I'll spend a little bit more time here with you. Ray said, how can we explain patterns to answer the question of whether we have an edge and are not trading in randomness? Well, so part of that is the question of statistical backtests. So, you're looking for an edge over the baseline return in your sample. You're also looking for backward tests, forward tests. Do answer that question. And the randomness is definitely the confounder. It's the thing that makes all of this so difficult. And that's true in so many disciplines. But the issue with trading is that element of randomness is so very huge compared to the signal. It's a little bit more difficult to tease out. But any kind of proper backtest system development methodology, that's really what you're centered around. If we want to avoid trading in a market that does not have momentum, Wouldn't that eliminate support resistance trades holding in sideways markets? To some extent, yes, but you know, it's I don't have a charting platform open here, but let me just go back and kind of find random chart here. Okay, so look here. This, you could trade around support and resistance. This is not really the same thing as what you have here, where you're, so it's a, there's still swings here, right? There's still swings. Now, they might be less predictable, but the problem when you get into, and how professional is this? Just gonna click through like 1,000 slides. The problem when you get to something like this is that you don't have any real swings. And the moves out of here can be so predictable. If you get into a trade, you know, you can do a lot of work with trades like this to get positioned correctly. I think the only way to trade something like this is to add when it goes against you, which is okay, but you know, you're not going to get these kinds of clean swings that not going to get these kind of clean swings that lead to easy profit targets. So you're, and you know, there also is a question of time frame, because if you have a, many times when you're trading within those ranges, a higher time frame would look like this kind of choppy crap, but that's what I meant when I said you have to like really focus on your trading time frame. Chris said, I mentioned once I'll start to focus more on intraday trading. I'm starting to work on TradeCraft, mean you put the intraday on hold? Not really. I have continued to do intraday trading. Much of my time, and I have a team here that's been very, very focused on helping me with TradeCraft. So there have been a lot of eyes on this and hands on this. A lot of people have helped with this, which, you know, we have a, that certainly contributed to the quality of what we're putting out here. But I think my trading is evolving more in a systematic direction. I hinted at that earlier in this presentation. And honestly, there are a number of personal reasons for that, but no, it did not, did not pull me completely away from intraday trading to do that. There certainly are, and there's actually kind of an interesting discussion in our Discord right now about the challenges of intraday trading. And I will, reiterate something I've said here over the past 10 years publicly many, many times. I think many, many traders struggle with intraday trading, and everybody wants to do it. And the reason they want to do it is, first of all, you can do it many times with pretty low capital requirements. So that's one reason. People also see a lot of the marketing where people make claims like, start with $3,000 and have 100,000 by the end of the year. It's possible, but it's far more likely, you'll just buy lottery tickets. Over and over again, I have seen struggling traders do better when they move to longer time frames. So I have to mention that. And I will tell you also, little aside here, when I started advising institutional traders and hedge funds, and many of these were heavily quantitative, I had over and over again the discussion about time frame. And many of these firms, I would say things like, in my personal trading, I had evolved to a style that focused on trades that lasted a few days. And then they say things like, oh yeah, like 2 to 4 days, right? And so, yes, and so this kind of army of hedge funds and very well trained and educated and capitalized institutional traders had found the same thing, because they objectively found clearer edges there. And this is also the experience of many developing traders who struggle trading a 5-minute chart forever and then give up. Many of those traders, when they gravitate to a longer time frame, it's not as exciting, right? But it takes a different kind of discipline, but they do find that their results are a lot better. So I just have to say that, because I know that there's this in the trading education community, there's a tremendous emphasis on intraday trading, and it's what everybody wants to do. And absolutely, you can do it. You know, it was my exclusive focus for many, many years. I traded one or sometimes two markets on 1 to 5 minute charts, and it was all I did. You certainly can be successful doing that, but it absolutely, I'm quite confident when I tell you, it's the hardest kind of trading. And it probably does not make sense if you, there are definitely things you can learn from intraday trading like that, but it doesn't make sense if you, once you spend some time working through the kind of the basics and you really want to drive towards success. Why are you playing this on like God mode? Why are you trying to play this game on the setting that is like barely humanly possible? Wouldn't it be nice to make more money on a longer time frame? So sorry about the rambling answer there. Good question. And folks, I think that is a good place to wrap up. We went on a lot longer than I thought today. I promised you a shorter session. I apologize for not delivering on that, but I hope I compensated by delivering good content. And I appreciate your time and focus today. And I will see you back for another Hudson session at some time in the future. Thank you.